Jai Hind everyone. Welcome to my YouTube channel, which is Explore Yourselves, Banking and General Knowledge, etc. Here I will discuss about group discussion topics related to the internal promotion examination for bank employees. Welcome to part 24 of my Path to the Corner Office 2025-2026 series, where I break down real bank promotion exam questions and give you clear, practical sample answers about group discussions to help you climb the career ladder faster. Today's group discussion topic: cross-selling of third-party products, ethical concerns. Introduction: cross-selling of third-party products such as insurance, mutual funds, pension schemes, credit cards, and investment products has become an integral part of modern banking. With shrinking interest margins, increasing competition, and pressure to enhance non-interest income, banks, especially in India, have increasingly relied on fee-based income through the distribution of third-party financial products. While cross-selling helps banks improve profitability and deepen customer relationships, it also raises serious ethical concerns relating to mis-selling, conflict of interest, customer exploitations, and dilution of trust. Therefore, the topic of cross-selling of third-party products and its ethical implications is highly relevant for bankers, regulators, and customers alike. Understanding cross-selling in banking. Cross-selling refers to offering additional financial products or services to an existing customer based on their relationship with the bank. Third-party products are those manufactured by external entities such as insurance companies, mutual fund houses, or pension fund managers and distributed by banks acting as corporate agents or distributors. Examples include life and general insurance policies, mutual fund schemes, PMS and alternative investment products, national pension system, credit cards, and co-branded products. Ideally, cross-selling should be need-based, transparent, and customer-centric. Rationale behind cross-selling. Banks justify cross-selling for several valid reasons. Diversification of income. Fee-based income reduces dependency on interest income, especially during periods of low credit growth. Customer convenience. Customers can access multiple financial solutions under one roof. Better customer engagement. Cross-selling deepens relationships and improves customer stickiness. Optimal utilization of branch network. Banks leverage their vast reach and customer data to distribute financial products efficiently. While these reasons are commercially sound, ethical challenges arise when business targets override customer interest. Ethical concerns in cross-selling. Mis-selling of products. The most serious ethical concern is mis-selling, where products are sold without proper disclosure or suitability assessment. Examples include selling long-term insurance policies to elderly customers, selling market-linked products to risk-averse depositors, presenting insurance as a fixed deposit or guaranteed return product. Such practices violate the principle of informed consent. Conflict of interest. Bank employees often face pressures to meet sales targets linked to incentives, promotions, or performance appraisals. This creates a conflict between acting in the best interest of the customer and meeting internal business targets. As a result, employees may prioritize high commission products rather than suitable ones. What is the coercive selling? Instances have been reported where loans are sanctioned only if insurance is purchased. Account opening is linked with mandatory product subscription. Customers are psychologically pressured using fear or misinformation. Such coercive selling is unethical and against regulatory guidelines. Inadequate disclosure and transparency. Ethical selling requires full disclosure of product risks, charges and commissions, lock-in periods, exit penalties. However, in practice, complex product features are often downplayed or ignored, especially for less financially literate customers. Like a sense of trust. Banks enjoy a high level of public trust. Customers often believe that bank officials act as financial advisors rather than salespersons. Misuse of this trust damages bank credibility, customer confidence, long-term brand value. Once trust is broken, rebuilding it becomes extremely difficult. Vulnerable customer segments. Ethical concerns intensify when third-party products are sold to senior citizens, pensioners, rural and semi-urban customers, low income and financially illiterate individuals. These customers may lack the capacity to understand complex financial products, making them vulnerable to exploitation. Arguments in favor of cross-selling. Despite ethical challenges, cross-selling should not be viewed as inherently wrong. Regulated framework exists. RBI, IRDAI, and SEBI have issued clear guidelines on suitability, disclosure, and grievance redressal. Customer choice is expanded. Cross-selling increases access to investment and protection products. Professionalization of banking. With proper training, bankers can act as responsible financial facilitators. Economic growth. Insurance penetration and mutual fund participation support long-term economic stability. Thus, the issue lies not in cross-selling itself, but in unethical execution. Regulatory and institutional safeguards. Regulators have taken multiple steps to address ethical concerns. RBI guidelines on customer protection and fair practices. IRDI regulations on corporate agency and mis-selling penalties. SEBI suitability norms for investment products. Grievance redressal mechanisms like banking ombudsman. Code of conduct for bank staff and distributors. However, effective implementation remains a challenge at the ground level. Role of bank management. Ethical cross-selling starts from the top. Management must balance business goals with customer welfare, avoid aggressive target-driven cultures, promote ethics over short-term profits, invest in staff training and certification, encourage whistleblowing and internal audits. And ethical culture cannot be enforced only through circulars, it must be practiced. Role of bank employees. Employees play a critical role as the last mile interface with customers. They should follow know your customer and suitability norms, clearly explain product features and risks, avoid misleading sales pitches, document customer consent properly, respect customer choice including refusal. Ethical conduct protects both the customer and the employee. Way forward, ethical cross-selling framework. To address ethical concerns, banks should adopt need-based selling model, decoupling incentives from aggressive targets, product suitability metrics, enhanced disclosure standards, financial literacy initiatives, regular monitoring and penalties for mis-selling, customer-centric performance metrics. Ethics should be treated as a strategic asset, not a compliance burden. Conclusion. Cross-selling of third-party products is an unavoidable reality in modern banking, driven by economic necessity and competitive pressures. However, when ethical principles are compromised, it leads to mis-selling, erosion of trust, regulatory penalties, and reputational damage. Ethical concerns arise not because banks sell third-party products, but because customers' interest is often subordinated to revenue targets. For sustainable growth, banks must ensure that cross-selling is transparent, voluntary, and need-based, and ethical. Trust once lost cannot be recovered through profits alone. Therefore, ethical cross-selling is not just a moral obligation but a long-term business imperative. A banker's success should ultimately be measured not by products sold but by trust earned. Thank you very much for your patience. Request to like, subscribe, and share.